Last class, we had a discussion about the SAP and the basic about SAP S4 HANA. So now we will discuss about the basics of accounting. So what is accounts? So basically, the accounts is called as a language of business, and account is nothing but recording of day-to-day transaction. So I hope all these basics even though I'm explaining you these concepts. So basically, the accounts is recording the day-to-day transaction, whether it may be in the business, whether it may be in the personal life, whatever you record, your expenses, your revenue, okay, whatever the day-to-day transactions you are going to record, those are called as a account. So accounting, so basically accounting is the process of recording, summarizing, classifying, reporting, and analyzing the financial data for a particular accounting period. That is called accounting period. Okay. So usually in the accounting process, we used to record the transaction, we used to summarize the transaction, we used to classify what type of accounts we are going to maintain, reporting and analyzing those financial data for a particular accounting period. Our accounting period will last every year. Okay, that is called accounting. So next, we'll see the objectives of accounting. So the major objective of accounting is to maintain the permanent records of the financial transactions. Then it is used to measure measurement of outcome or analyzing of profit and loss accounts. Then analyzing the financial positions. Then effective use of resources. See, if we manage finance effectively, so we can effectively utilize the resources. Okay, how much amount we are going out, how much amount we are getting. Okay, whatever the profit, whatever the losses. So all those things, by analyzing those results, we can effectively use the resources. So then we can prevent the frauds. Okay, so we can prevent the frauds, whatever the frauds will happen in the finance, we can prevent it if we maintain a proper accounting, and we can take the decisions. Okay, it helps us to take the decisions. That is called decision making. And value of the business, if we maintain proper accounting, it gives a value, it gives the credibility to the business. Next. Next, who are the users? Who use the accounting? Everyone use the accounting, like business owner, like management, like investor, budget officers, creditors, bankers, auditors, stock exchanges. Okay. So basically, we have different modes of accounting. So one is manual way. So earlier we used to maintain the bookkeeping. Okay, we used to maintain all the accounting in the books of record. We used to record in the books. Those are called manual way, that is bookkeeping. So next we have computerized way using softwares. Okay, these two, one is computerized way, that is using software, another one is manual way. So next we'll understand what are the business organizations we have. So when you observe in the market, we have different kinds of businesses. Those business as categorized into manufacturing business, then trading business and service business. See, wherever you go, you will get three kinds of businesses. Okay, based on this, different types of businesses are there in the market. So manufacturing businesses means where it produces the product, where we are going to process or process of transforming raw material into finished goods. Then trading business, process of purchasing and selling of goods. So buying and selling of goods. So buying in a lesser price, selling in a higher price. That is called trading business. Then we have service business, giving services for their product. So if you sell any product, and if you are going to provide a service, there's all services business. Under these business organization, we'll get a lot of businesses. Next. Next, we'll understand basic terms of accounting. So I hope everything you know, as you are from commerce background. So even though I'm explaining you the basics, where we are going to use this in the SAP. So capital, basically the capital is the investment or contribution of wealth or cash invested by the owner to start a business, and investment made in the middle of the business is also called as a capital. Okay, whatever the amount you are going to invest to start a business, that is called capital. Even though if you are investing in the middle of the business, that is also a capital. So capital will be always asset minus liability. Whatever, see, we are going to calculate how much capital we have. That will be calculated based on the asset and liability. So next, drawing. So drawing is nothing but the amount withdrawn or value of goods used by owner for personal use is called drawing, which decreases capital. Let's say if we have invested 1 lakh or 10 lakh. Okay, at any point of time, if the owner draws the amount, okay, so that is called drawing. And if the drawing happens, the capital will be decreases. Next, we have liability. So liability means credit made by the business. Okay, it's just a credit made by the business. We have a different types of liabilities, but credits, we have different types of credits like loans, bills payable. All those are called liabilities. Bills payable means, so suppose if you want to make any payment to the vendor, so that is called bills payable. And we have different types of liability. So fixed liability, basically the fixed liability credit made for a long term period, that is more than a year, and it is paid for a longer term. Long term loans are called fixed liability. Even capital is also a fixed liability, because we need to get a break even. Na? So current liability means a credit made for a shorter period of time, that is less than a year. It is paid within short term, that is called bills payable. Whatever the payment we'll have to make to the vendor, that is called bills, current liability. Next we have asset. So basically, asset is a reverse of liability. It is the economic resources of a business which are valuable things. Asset is a resource, economic resources of a business which are valuable things. So example, building, plant, machine, cash in hand, cash at bank, furnitures, goodwill, these are all called assets. Even in asset, we have different types. That is current asset, fixed assets, and current asset. Fixed assets are fixed in nature. It cannot be easily converted into cash, like land, building, and furnitures. And even we have current asset. So, sorry, there are two types of fixed assets. One is tangible and intangible asset. Intangible asset. So, tangible assets are assets which we can see or touch. Those are called building, furniture, uh, okay, then land. These are called tangible assets. Next, we have intangible assets. So that we cannot see and touch. Those are called goodwill, patent, license, trademark, copyrights. These are all called intangible assets. See, if you're not getting, so please ask, unmute yourself, and you can ask the doubts at any point of time. Okay, fine.
Okay, sir.
So next we have current asset. So current assets are not fixed in nature and are not fixed in nature and can be easily converted into cash, like cash in hand, cash at bank, bills receivable, finished goods, raw materials. These are called current assets. Okay. So we'll use all these in SAP. Next, we have inventory. Inventory means stock of raw materials used for the production, and stock of finished goods for the trading is called inventory. Inventory means stock of the material. Okay. Next. Next, we'll see creditors. So basically, creditors, as you know, creditor is the person that company has to pay. That is vendor, where we are going to make the payment to the vendor. So bills payable to the supplier on credit for the purchase of goods, and it is a current liability. Creditor means where vendor will have to make the payment to the vendor. So debtor means, so debtor is a person. One second. Okay, debtors is a person where company has to receive the amount. Okay, like bills receivable from the customer for the sales of goods, and it is a current asset. Next, we have accounting period. So basically, the accounting period, the period carried out for 1 year is called accounting period. That is April 1st to March 31st of every year in India. But in different countries, with respect to their countries, they will be having a particular accounting period. Okay, if you go to US, that is Jan to December is the accounting period. If you go to Dubai, July to June is the accounting period. If you go to UK, October, something is there. Okay, so based on the country specific, we'll be having an accounting period. So next we'll have opening balance and stock. Opening balance means the stock remains unstored at the beginning of the accounting year is called opening stock, and the amount which remains at the beginning of the accounting year is called opening balance. And closing balance and stock. So basically the stock remains unsold at the end of the accounting year is called closing stock. Closing balance means the amount which remains at the end of the accounting year is called closing balance. Okay. Now, so transaction is nothing but transfer of money or worth from one party to another party is called transaction. Now, so it may be cash, credit, RTGS, net. Next, net income. Basically, net income is calculated by taking revenue and subtracting all the expenses. Gross profit, it is calculated without expenses into account. Next, goods. So goods, we have purchase. So purchase means purchasing of the goods. Purchase return, if you have any returns in the purchase. Then we have cash purchase. Then we have sales, cash sales. So credit purchase, cash sales, sales return, then cash sales. Okay. So these are all the basic terminologies where we are going to use it in the SAP system, even credit sales. So next, this is very important, modes of accounting document. So basically, we have different types of accounting document like voucher. A voucher is a document which contains the detail of transaction. Then we have receipt. When trader receives cash or check from the customer against goods sold by him, he issues receipt which contains name and amount details of the goods. So it's just an acknowledgement. Okay, one second. Next, so invoice or bill. So when trader sells the goods to the buyer, he prepares sales invoice, which contain details of the goods, person, amount, and terms of payment. So receipt is different, invoice is different, bills are different. So purchase invoice, when buyer purchase the goods from the supplier, he receives the invoice from the supplier. So that is called purchase invoice. That is, see, this is vendor invoice, that is customer invoice. Next, financial statement. Basically, whenever we are going to generate the report, we'll be having a different types of statements. So in that one is trading account. So which displays the transaction of buying and selling of goods, and it shows gross profit and gross loss of a company at the particular period. Just trading account. It contains gross profit, gross loss, where we are going to record all buying and selling of the goods in the trading account. Next. Next, see that is gross profit is equal to net sales minus cost of sales. Next, we have profit and loss account, P&L, or income and expense statement. It displays net profit or net loss of a business for a specific period. It contains all income and expenses incurred over a period of time. Then balance sheet. So basically the balance sheet, so these are all you know. So it shows the total asset and total liability of a business, and it shows the net worth of the business. It contains assets and liability. So basically, whenever we are going to see the credibility of a business, we are going to see the balance sheet. Okay, it shows the net worth of the business. If you have uh, more assets, then the credibility is good. If you have more liability, then its credibility is not good. Then trial balance, it shows all debit and credit side transactions. So these are all the basic things which we will have to understand before starting SAP. So this is very important, you can see. So types of accounts. So basically we have three types of accounts: personal account, real account, and nominal account. So the accounts representing the person or a company or group of a person or capital account are called personal account. When the amount, when the account is related to person, when the account is related to company, when the account is related to particular group of person, those are called personal account, like customer account, company account. Okay, if you have company bank account, that is a personal account. Real account mean accounts represent assets like land, building, cash account. Then we have material. These are called real account. Nominal account, account representing the expenses and losses like bills, salaries. Okay, so those are called expenses. Sorry, nominal account. So we have a golden rule of accounting. So whenever you are doing any of the transaction, let's say if you are doing with the personal account, then debit the receiver and credit the giver. Okay. Then in the real account, so debit what comes in, credit what goes out. Hmm? If it is a nominal account, so debit all the expenses and losses, credit all income and gains. Okay. So these are the golden rules. We will follow this at the time of posting any of the transactions. Next. So next we'll dive into SAP by tomorrow. So I will start from the basics. Okay, even though if you don't have any idea, so I will start from the basics. So if you have any questions, we can discuss, or else we can end and we'll continue tomorrow.